Hey, what's going on, Wealthy Legacy Journeyers? Welcome back to another episode of The Wealthy Legacy Journey. I'm your host, Kendell Liden, and the title of today's episode is Investments Up, Expenses Down, and the Art of Delayed Gratification. We're going to mix it up a little bit today. Usually I start off on a real estate tone and kind of talk about the brokerage, but I want to talk some personal stuff first so you can understand more of the context behind the title of today's episode. Then we'll jump into the brokerage updates and things like that. So from a personal note, it's been really interesting as we're approaching that 100 episode mark, thinking about, okay, this has been a big goal for me for a long time now of getting to 100 episodes with the show on the Wealthy Legacy Journey. What is going to be the big next step? What's the next step for the show? What's that milestone that we're hitting in order to move forward? One of my mentors that I had, I believe it was Russell Brunson, one of the things he talked about was the importance of just hitting 100 repetitions in whatever it is that you're doing, whether it's 100 days, 100 weeks, 100 episodes, whatever. It's just a solid rhythm, a solid habit. And I can say now I've gotten so much experience, practice doing videos and things like this. And, being in this rhythm of getting to episode 100 it's been a lot to keep up with. I had multiple times where I was like, is this even something I want to do? Is it not something I want to do? Is it something I want to keep up with? Do I even have the time? And I've dropped off a couple times along the way. From a personal aspect, though, let's talk about delayed gratification. So we were breaking down the math, or at least I was the other day, and I was looking at, okay, where is my current standing? What's my current net worth? And this is actually a really exciting breakdown to do. So I essentially look at net worth and I broke apart the assets column and the liabilities column. I really broke it down from like a Robert Kiyosaki's cash flow pattern breakdown, as far as like how do you measure income and expenses, how do you measure assets with net worth and or with assets and liabilities, and then how do you measure your available borrowing power, whether that be private money or that be partnerships or that be hard money or banking money, anything like that, anything that you can like borrowed money, or partnerships. So going back to that net worth column, looking at assets versus liabilities, on the asset side, we have about $100,000 worth of assets in Hudson. That's going back on the market this week. We're pricing it more aggressively, which is where I think it'll actually sell. And that's why I've been using about $100,000 ballpark for the value of that asset as I've been pricing it out over the last few months. We have $18,000 currently in the market with another 12.5 sitting there ready to deploy. And then we have $10,000 cash sitting aside for a marketing fund for the Wealthy Legacy Journey. We have $29,000 sitting in our fully funded 6-month emergency fund, and we have $5,000 currently sitting aside in our fund money from a deal that just came through. And so we took 10% of it, which was $5,000 of that deal. And that is now sitting there, and we're going to slowly go through that over time. It just helps make life a little bit sweeter. When you think of fund money, you might think of like crazy big things like vacations and all that kind of stuff. And the last time we got some fund money, whenever we sold the Palestine lot, we did use that in order to pay for our beach vacation that's coming up in August, which was really exciting for us. But this one, we're actually going to use this $5,000 buffer to just be able to buy new clothes, because like Libby and I are both wearing clothes from like high school, or years old clothes, be able to buy some new t-shirts, buy some polos, probably like Ambition X stuff, which is going to be really cool. And then also just like the fun things that you buy every month, because we're pretty tight. We very particular about every single one of our dollars and where it goes. We try not to pull too much out of that just for these like frivolous wants and desires of life. That's what fund money's for. So this is where we're kind of in second generation money here. Our money, our time and energy has gone into deals, and those have paid off. So now we have this extra fund money to spend. Man, it feels good getting to this point where some of this stuff that we were talking about a long time ago in the show is now paying off. And so if you add that up between the $100,000 in Hudson, $18,000 in stocks, and that's between SPLG and BITO, $12,500 sitting there cash to deploy, $10,000 marketing fund for the Wealthy Legacy Journey, $29,000 emergency fund, and $5,000 fund money, that is a current total of $174,500. Now, if you fast forward, I guess we're almost, I think, episode 90 today. If you go 90 episodes back, you'll see a guy standing here that had none of that. They had nothing. We had, I think, barely like a month sitting in the bank for emergency fund. And man, it's been just such a crazy climb over the last essentially 2 years to get to this point. And then if we look at the liability side, which in my mind, assets is anything that is currently producing cash, or it like is cash flow positive and or going to produce a return in the next 12 months. And so when I look at Hudson, yes, that costs me money to hold it from like a mowing perspective, tax perspective. We don't have any debt on it currently, but that is actually going to be a capital gain on the land because that was a development play, right? But I look at something else like a car or a house that I currently live in, I currently utilize. That's only going to cost me money every single month in gas and maintenance and expenses for that vehicle and repairs and all that kind of stuff, insurance, right? So at the end of the day, it's cash flow negative, right? And I'm not planning to sell that at a profit at any point over the next 12 months. And even the minivan, like the vehicle is just a depreciating asset. So I'm cash flow negative on it. It's a depreciating asset. So it's not something that I see. So I went ahead and priced in the new minivan that we're planning to buy out of this current deal that just came through to get us closer to $100,000 on a minivan, like we talked about, $15,000. We have about 25,000. I'm being a little conservative there, but net worth value on the fifth wheel, and then we have $2,000 on my little Ford Fiesta, and so that's $42,000. Now, if you add up our $174,500 in net worth on the asset side, and you add up our $42,000 on the liability side of that column, we have a total net worth of $216,500. Like, wow. First off, praise the Lord. Been huge breakthrough. It's been a long journey to get to this point. I'm so grateful to be where I'm at right now, building the brokerage, building more, building into the future, but also having learned the principles in order to be able to hold on to net worth like that, but not just stuff it away into a bank account, but actually get it to start rolling and growing and building and doing something bigger. I feel like that's probably one of the biggest things that held me up when I was an entrepreneur for the last 5 years is I didn't understand how to hold on to the earnings that I made. I started getting pretty good at getting to like 100, $150,000, but then I would hit that point, I would sputter out, I'd be like, all right, I'm done. I didn't learn how to build a team, I didn't learn how to scale, which I have some exciting updates on the brokerage side of that today, but I never went into that because I was afraid of doing it. I would get burnt out. I would then take a big break from what I was doing and we just start spending through that cash versus no, that is not spending money, that is investment money. And that's why I say in the title, investments up, expenses down, and the art of delayed gratification. Because I'm not going to lie, this last weekend, it was a hard weekend. Our little septic tank that we have that took to our fifth wheel, mind you, we have 5 people living in a 400 square foot fifth wheel. Not an easy thing to do. It's very mentally taxing. It's been very difficult to get through. Our septic tank, it rained a bunch and it started lifting up out of the ground because it's not a concrete tank. It's a little plastic tank that pumps it actually to the main septic tank, came up out of the ground. So we had to dig up all the dirt. We had to dig up all, and mind you, I'm the one who installed this tank just it's a little under a year ago now. Never thought I was going to have to touch it again. One of the harder projects that I've ever endured as far as like a single difficulty on a single project. And having to come back to it and redig that into the ground this weekend was absolutely terrible. I mean, that was mentally, it was just, do I even have the strength and mental dexterity to do that in this season, along with everything else that I'm currently doing? And I'm not going to lie, we sat here and really thought, should we just go get a rental house? Right? We've got cash. I just told you we have $174,500 worth of assets. And I don't say that to brag. I say that from a mathematical standpoint. We have cash now, right? Specifically, if you look at cash, we've got 29,000 cash in the emergency fund. And I need to stop and take I need to talk about that at a point in this episode because we changed up our plan from last week. We got $5,000 in fund money. We got $10,000 in a marketing fund, which I'm going to talk about that in a little bit. We've got 12,500 to deploy. So if we were to look at just the cash that we currently are sitting on, we're looking at, let's see, what is that? 29, 39, 39, 40, 44 plus 12. That's going to be 44, 54, 55, 56, 56, 5. So we could pay for a rental house in our area for about 2 years. And that doesn't even account the cash that we would make from selling our fifth wheel. So maybe that even pushes to closer to 3 years without even having to increase our income in any way because we have that cash. But then the question is, well, what is that cash for? Is that cash there for growth or is that cash there for expenses? And that cash has really been dog-eared and set aside for growth. And again, getting a rental house is only an expense. And we don't even own the house. So it's not even a net worth liability. It's completely just an expense. Right. And so I look at that, and that's where Libby and I, we really spent some time praying and thinking about it because life has been so tough lately inside of that fifth wheel. But we really stepped back. We analyzed our goals. We figured out where we're at. We looked at where the brokerage was at, and we just said, if we can just hold on maybe 6 more months and see what the brokerage is able to produce, we could have a better idea. And another thing is, I want a truck. I want a truck, and I probably only want to spend about $25,000, $30,000 on a truck. I mean, sure, I could spend a lot more, but I could get a really decent truck for $25,000 to $30,000. I've got the cash. And now it's taking discipline, self-control, and tapping into that art of delayed gratification in order to not spend it on that. Trying to make those wise decisions day in, day out. It's tough enough to do on a good day. It's extremely hard to do on those hard days. So anybody who's in this journey trying to build wealth, trying to grow from more, I just want you to know right now that if you're going through a struggle, I connect with you. I get it. I'm in that same boat right now where it's like, okay, I've now ahead enough that I've got cash. I've been here. This is my third time here. And I'll tell you from experience, don't do what I did twice before and spend it all. Because the road, when you hit back to, it feels so good spending it. It feels terrible when you get back to zero and you realize how hard it was to climb up that mountain the first time, the second time. Now I'm on the third time. I'm not going back. So another thing I want to mention about emergency fund before we were talking about, do we tap in to do some gold? Do we do more BITO? At the end of the day, Libby and I agreed that it would be wisest to stick away from gold on our emergency fund after looking at it because gold is very volatile. If you look at the Dave Ramsey model, that 6 months is really supposed to be cash. Is it painful for me to think about having $29,000 just sitting there? Now, granted, it's not going to be just sitting there. We're actually opening up a high yield savings right around 4% to hold that money, but to have that money just sitting there. In a sense, it's painful, but the moment that if life goes sideways and I need that cash for an emergency and I have it right there and I don't have to go borrow from somebody, I don't have to go find the money, but I have it there, I guarantee you that's not going to be painful. I have what I need to cover some of life's biggest things that I could throw my way, or at least get a good start on it if it's a really big thing. From a real estate perspective, let's switch gears now. We have assistant team leads now for all of our positions. So this is the purchase team, the sell team, the leads team. So big shout out to Miss Billy Sahutsky, Mr. Scott Jones, and of course Mr. Artie Reynoso. Artie is in the assistant sell team lead role. Scott is in the assistant purchase team lead role, and Billy is in the assistant leads team role. And that just frees up more bandwidth for myself and Nathan to be able to focus on the higher level stuff, focusing on the marketing, focus on the build out, focus on that future growth. Again, one of the things that I never let myself do out of fear, and now I'm having to get past my uncomfortable zone and grow into that next step that I need to grow into. I was really challenged by two books, EntreLeadership by Dave Ramsey and Buy Back Your Time by Dan Martell, of how do you get past that point of exhaustion in your business where you're doing everything yourself. You build out a team to where that team can start taking care of a lot of that load for you. Another exciting thing for team growth is we now have a full marketing team, and I'm very excited. We have our first official meeting and brainstorming session to move forward on things, but shout out to Miss Tiana Fandozi Bugs, Miss Christian Harris, and Miss Debbie Viverito, who essentially, if you look at the three of them, they're all powerhouses in their own regard, whether it's organizational aspect or it's a creativity around how to get leads in the door, how to, advertise our listings, or how to recruit. Each of them brings a specific skill set to the table that then Nathan and I can just pour ideas into, things that we've seen into, but then really they're going out, they're being the ones who are deploying in the market, doing a lot of those things to take that bandwidth off. Even another thing, when I think about, basically over the next 6 weeks, we're doing a huge marketing push. We're going to have 2 weeks where we're building out our listing ads plan. We're going to have 2 weeks of building out our leads ads plan. And then we're going to have 2 weeks where we're really starting to push again on the recruiting side. And we're going to be building a webinar, and there's going to be, we're going to call it show and tell. I'm very excited about that. I got a lot of things I'm going to be building here over the next 6 weeks. And then after that 6 week push for marketing, we're going to do another 4 week push or so for recruiting. And our goal is to end up around 20, 25 agents. So currently we're sitting at 14 agents plus Nathan. So that makes 15 total if you count all the licensed agents that we have. Our goal is to get to 20, 25 agents. So we really need like another 6 to 10 agents is kind of the goal on this next recruiting wave. And I'm really excited to be able to go after that again once we have those leads in place. But even when I was thinking about the next wave of recruiting, I thought I would love to get these assistant team leads more involved in that process. Why? Because it's one more thing that I can hand off. And so shout out again to Artie. He's actually taking over the onboarding process. So when somebody comes into the office to onboard, instead of me having to take 30 minutes of my day to onboard somebody, I don't necessarily have to be a part of that setup process. Artie's going to now take over that setup process. That's going to free me up to be able to build more for the front end of the company to bring in more deal flow, more cash flow, more revenue, more ads, all that kind of stuff for the company to really get the engine going. And that's just a benefit to everybody on the team. And so, just thinking about what are the ways that, even Dan Martell talks about this a lot. And I know that's going to be an annual read for me, probably coming up in January, February of, next year. That's already on my mind as I need to reread that book and figure out what did I miss the first time around that I can apply over the second year of the brokerage. But really having this mindset of how can I have other people do the tasks that I don't necessarily have to do so I can get that time back and I can redeploy that in better ways to be able to move the entire company forward, which benefits everybody within the company. Plus, it allows us to grow and bring in more agents, which allows us to provide more, the ability to be able to help the market, be able to help our local communities take more market share, which only strengthens the brand of the brokerage as a whole and only empowers everybody more who's inside of that brokerage. So that's really exciting. On a note for stocks, like I said, we've got about 12,500, maybe a little bit more, a little bit less, just depending on what happens, to buy some more. So we've got 3 kind of points that we're planning to buy on a bull breakout. Maybe it'll only be 2. Just depending on price. And then on the deeper pullback, we do have 3 points that we're planning to buy. So basically, it's at the zone right now where it's like, okay, the market could freak and we could drop further. Or the market could just get excited about what it's seeing. There could be some huge trade deal announced and we could break out. But we're kind of in this middle zone where people don't know what's going to happen. Currently holding $18,000, which I'm pretty happy about when you look at the percentage of capital we've allocated to stocks. I like our cost basis. I like where we're currently sitting. Our cost basis is somewhere around like $62, it's like 61.84, I think, on SPLG. Still selling covered calls on that. Still collecting, quarterly dividends on that. We are recovering monthly and collecting monthly dividends on BITO. Not currently selling covered calls on that one though, because for me that's a growth, and I really want to just not put a top end on that until we start getting more to like areas where I think we're going to start experiencing some larger resistance. So that one's kind of full throttle, wide open right now, just for net worth collection. But essentially, okay, if we're going to go back, look at the main market, look at the S&P 500, look at SPLG. On the bull breakout, that to me is breaking that 200 period simple moving average, holding and retesting that 200 period simple moving average, and then the golden cross, which is where your 50 period simple moving average crosses over the 200. That puts you back into a bull move. Those are the 3 points that I'd be willing to buy, saying, hey, I already have a low cost basis. Yes, it pushes my cost basis up, but there's strength in the market. On a deeper pullback, I'm willing to buy discounts at a 20, 25, and 30% pullback, and I actually have those orders currently sitting in there in the market. So if we pull back to those levels, it's going to automatically buy for me. Now, if we do pull back into those zones, total cost on that's going to be more like $15,000, $16,000. Obviously, I only have 12.5 to deploy, so I'm going to have to transfer a little bit over to be able to cover that trade, so we're not leveraged in any way. And then at that point, we just let it sit. That's money that I don't plan to touch for 5 years, right? So again, that's something to think about. Even when I was thinking about how much money are we allocating into stocks, it's like, okay, this is money that I'm planning to just like sit there and just grow over time. So if we do go into a deep recession, if there is a major pullback, I'm okay with having that money sitting there. I hope that we can grow out of it. I want to see my net worth grow, but it's a great chance to just deploy some capital over there and just have kind of mixed exposure. The last few notes I want to make on this episode, one is make sure that you guys are paying yourself first in 2025. I didn't build $174,500 worth of assets by paying myself second. I was very intentional with every single dollar. If you look all the way back through, I'm very excited for episode 100. I'm thinking about like I'll do probably like a part one intro by myself. I want to do a part two with Libby where we talk about the journey to this place. But I mean, if you go back through, like the first thing we were doing is whenever I was making more with acquisitions, we were paying down debt like crazy. We got completely out of the hole there. We started building up our emergency fund. We went and bought a tax lot. There was a lot of things that we've done, different partnerships we've been a part of, a lot of things that we've been able to do in the day to day on the side, in order to be able to continue to build that net worth forward. But that did not happen again from paying ourselves second. We didn't pay all the other bills first and then say, okay, what do we have left for us? We said, this is how much we need to be paying us every single month. And then we figured out a way to make that happen. And then we paid all the rest of the bills. And it was by doing that and that mental, and then also just I think the struggle of going through that's really helped change my philosophy around money, how I hold money, retain money, spend money, and the power of a dollar. Now, when I think about the power of a dollar, I'm actually really excited. So for the Wealthy Legacy Journey, we're going to begin marketing the show more aggressively at episode 100. So I got about 10 episodes left, about 10 weeks, and I'm very excited because I think we're in a really strong place of the show. I think there's a lot to talk about with the brokerage. So my goal is to get some guest speakers in the show, and I also want to be a guest speaker on some other shows and just begin building up the brand bandwidth of the show, and also building up my personal brand because I know that's only going to help me develop not only the brokerage but all companies, going forward. And I'm just really excited about that. And so that's why we actually set aside $10,000 of marketing towards the Wealthy Legacy Journey. Essentially, half of that's going to be ad spend, and half of that's going to pay like a VA to put together the ads and basically take these videos, edit them, make them look a little bit better, turn these into like shorts and reels and all that kind of stuff, as well as post it to YouTube and all of the things. And then we'll put a little bit of ad spend behind them each and every week just to get views and visibility and all that kind of great stuff. So what I would say at the end of that, going back to the title of today's episode, again, when you have your money coming in, if you're trying to figure out how do I build wealth, how do I change the trajectory of my family? How do I change the trajectory of my growth path? Pay yourself first. Invest in yourself first. Keep your investments up. Keep your expenses down, right? And learn the art of delayed gratification. Can I go out and spend the money that I have now on luxuries? Yes. Is that a wise decision that's going to pay off well for me in the long term? No, because those luxuries are going to be depreciating liabilities. They're going to take money away from me, and they're also going to go down in value over time. I need to learn how to deploy my capital into the highest ROI opportunities until I'm so far ahead that I can then buy those luxury goods, and it's like a drop in the bucket. Doesn't even make a difference. So if I could encourage you with one thing today, it would be that. Let's close out with our identity mantra and close out today's episode. I'll say it first. You guys say it after me. I explore the unknown. I conquer new frontiers. My journey is powerful, and my wake is a wealthy legacy. Awesome, guys. And as a reminder, the way we define wealth here at the Wealthy Legacy Journey is simply the ability to cover your month-to-month expenses without having to lift a finger. And the way we define legacy is leaving a long-lasting impact on others who come after you as they receive the fruit of your labor, whether that fruit be good or bad. Remember, we always are going to leave fruit, but the way that you leave good fruit is you plant good seeds, cultivate good trees, and then you will produce good fruit. It's been awesome hanging out with you guys on this week's episode, and I will see y'all on the next one. Bye, everybody.